Fear of missing out, or FOMO, is the intense feeling you must immediately buy a cryptocurrency because its price is soaring. You know, it is a powerful psychological trigger that makes people act on impulse, not logic. You see a coin's value doubling in a single day, and an internal panic sets in. You imagine everyone else is getting rich while you are stuck on the sidelines. This feeling often leads to hasty decisions, such as buying an asset at its peak price without understanding its fundamental value or the risks involved. This emotional reaction is a common trap, especially in a market as volatile and fast-paced as cryptocurrency. This cycle of hype and fear is a constant in the digital asset space. A recent example might be a new meme coin that suddenly gains traction on social media platforms like Reddit. Influential accounts start posting about its incredible potential, sharing charts that only show a steep upward climb. The danger of FOMO extends far beyond a single bad trade. It fundamentally undermines a trader's entire strategy and discipline. When you act on FOMO, you are essentially gambling, not investing. You are betting that the price will keep rising without any data, just hype. This emotional decision-making clouds your judgment and makes you ignore clear warning signs. A price up 300% in 2 days is far more likely to correct than to rise another 300%. FOMO makes you forget the simple principle of market gravity. One immediate consequence is entering at a terrible price. Buying at the peak of a parabolic rally is a classic retail investor mistake. You are here. Buying at the top maximizes your risk and minimizes potential profit. Early buyers are looking to sell and take profits. New buyers provide the exit liquidity for the early investors. When selling pressure outweighs buying pressure, the price collapses and FOMO buyers suffer big losses. FOMO pushes traders to abandon carefully constructed plans. To combat the emotional pull of FOMO, you must ground your decisions in objective data, and the most accessible source of data is a price chart. Learning basic technical analysis is like learning to read a map in unfamiliar territory. Instead of listening to the confusing shouts of the crowd, look at the chart for a clearer picture of where the market has been and where it might be headed. A chart provides factual information about price action, trading volume, and market trends. It cannot be manipulated by a single opinion or a hyped-up social post. Look beyond a single short-term time frame. A 5-minute chart can show an explosive upward spike, but zoom out, 4-hour or daily, and that spike can be just a minor blip in a larger downtrend. Checking multiple time frames gives context and perspective. It helps you tell a sustainable move from short-lived volatility. To consistently avoid FOMO, you need a repeatable system, a checklist of actions to follow before you ever click the buy button. The first and most important step is to always trade with a plan. Your plan should explicitly define your goals, your time horizon, your strategy. Before entering any trade, you must be able to answer 3 questions. What is my reason for buying this asset? At what price will I take profits? At what price will I cut my losses? Writing this down creates a contract with yourself, making it much harder to deviate from the plan when emotions run high during a volatile market move. Next, you must practice strict position sizing. A common rule among professional traders is to risk no more than 1% to 2% of their portfolio on any one idea. Example: if you have a $10,000 portfolio, this means your maximum potential loss on a trade would be $100 to $200. This simple rule is incredibly powerful. Always use a stop-loss order. Similarly, you should have a take-profit target in mind. Using these order types automates your discipline. The crypto market is inseparable from social media, a massive echo chamber where hype and panic spread fast. Platforms like X, Reddit, and Telegram breed FOMO with unverified rumors and exaggerated claims designed to trigger an emotional response. To protect yourself, consciously curate your information diet. Unfollow hype accounts and follow reputable developers and analysts. When you feel a strong urge to trade, pause. Step away from the screen. This distance lets the emotional surge subside. Finally, develop healthy skepticism. Verify news from multiple, reliable sources before you act. This places a logical barrier between emotion and your decision. In conclusion, the fear of missing out is a powerful and destructive emotion in crypto trading. but you can learn to control it. It pushes traders to act on impulse, buy at market tops, abandon sound strategies, and causes financial and psychological stress. The antidote isn't better hype, it's a fortress of discipline, logic, and preparation. Commit to a systematic approach, navigate volatile markets with confidence and calm, act on evidence, not anxiety. This is the difference between gambling and investing. Core principles for defeating FOMO are simple and effective. First, written trading plan. Define entry, define exit, define risk rules. Second, data, not drama. Read price charts, analyze volume, check multiple time frames. Third, strict position sizing. Prevent any single trade from devastating your portfolio. Finally, manage your information intake. Curate your social feeds, step away from the screen when overwhelmed. Patience is your greatest asset. It's okay to miss a rally. Sitting on the sidelines and observing can be the most profitable move. It prevents costly mistakes. Don't try to catch every move. Protect your capital, grow it steadily over the long term. Avoid the stress of chasing spikes. Apply these rules consistently. Build long-term success habits. Learn to spot FOMO as a signal to be cautious, not a call to act. Take these steps to heart, implement them daily, and become a more disciplined, profitable trader.